Welcome to the Gold Exchange podcast, where we untangle market.
Monetary metals is unlocking the productivity of gold, but the Fed has unlocked the undead to feast on our economy. So we're dedicating the entire month of October to discuss zombies. Our fearless leader, Keith, will demystify the Federal Reserve's Frankensteins with top zombie experts from around the globe. Will zombies take over our economy? Does anyone at the central bank even have a brain to feast on? Will Powell have what it takes to defeat the zombie horde, or is it all over but the show? Your only hope to find out is here on the Gold Exchange podcast.
Welcome back to the Gold Exchange podcast. My name is Benjamin Nadelstein here at Monetary Metals with founder and CEO of Monetary Metals, Keith Weiner, and our special guest for today, Daniel Lacalle. Daniel Lacalle, author, economist, and chief economist at Tressis. Now, Daniel, I want to jump right in. I know we're in a bunch of different spots all over the world. I'm here in the United States. Keith, you're in Zurich. Daniel, where are you? And what do you see around you at the moment?
Talking from Madrid, Spain, recently arrived from the US and the UK, so seeing a little bit of everything and a little bit of fun in the UK actually these days.
Yeah, well, let's start with some fun in the UK. There's been a lot of talk about Liz Truss and some of her policies that she was planning on implementing, and I think there's in some ways a scapegoating happening, right? I think you talked about this. Liz Truss, her policies come out, and next thing you know, there's chaos in the markets. Is Liz Truss to blame?
Certainly not. No? There's chaos in the market in Japan. There's chaos in the market in Europe. There's chaos in the market everywhere. What people are doing is to utilize a catalyst that is fake. A budget that is obviously a very bad budget because it's a deficit spending budget. Very Keynesian increase in spending and reduction in taxes, and say that was the reason why the pound fell and why pension funds all of a sudden needed to provide higher levels of collaterals for their margin calls. Well, obviously that has absolutely nothing to do with the budget. What has everything to do with the collapse in bonds and the situation in markets in general is interest rate hikes and this global dollar vacuum that we're living in, which after years of monetary excess, what we have is margin calls in energy providers, margin calls in pension funds, margin calls in everyone that bought into the aggressive monetary laughing gas situation. So nothing to do with the budget, but anyway, Miss Truss has resigned. And interestingly enough, as you will see, we will have another budget in the UK where the deficit will increase, the spending will increase, but they will say that they're calming the markets. Mm-hmm.
I was just going to add two things. One, the problems in the pension funds are obviously decades in the making, and then to blame it on Truss is terribly convenient. And then two, it seems like every country in the world has two parties, the party of tax and spend versus the party of borrow and spend. Yeah. And ironically, borrow and spend, Keynesian was a hard leftist of his day, or Keynes, excuse me. The party of borrow and spend today seems to be the conservatives. Yeah. But tax and spend seems to be the left. Yeah. Although modern monetary theory, I think, is making inroads on the left, and MMT says, you don't have to tax at all, except as an inflation sop.
Exactly.
So Truss resigned today because I hadn't seen that news yet.
Yeah, she has resigned. It is Thursday, and she resigned as was expected. To be fairly honest, it was the chronicle of something that was going to happen almost inevitably. No, but funnily enough, at the same time as she resigned, what I find most interesting in terms of what we're likely to discuss further is that the Labour leader was mentioning what would be his massively different economic policy. And what is the massively different economic policy of the Labour leader? Spend a lot more and tax a lot more.
And not allow domestic production of natural gas.
Exactly. Well, that's the other thing. Ban fracking. Obviously, it's sort of a train wreck, to be fairly honest.
Yeah, no, it is. I saw this is a few days ago, into your comment about it was inevitable, this press conference that Liz Truss had. And of course, the British reporters are terribly, terribly polite, unlike American reporters. But the first one said, with Kwarteng out, why do you get to remain as prime minister? And then she somehow dodged that question. And then the next one said, well, yes, just to follow up, why should you still be prime minister? And they just kept asking the same question. It was like, wow, this was really open insurrection, mutiny on the bounty. And, I don't know how a politician survives that once there's that feeling of the inevitable. And I guess she didn't. So on to the next one, whoever it may be.
I want to jump in here because this idea, I know, Daniel, you write about this, spend now, deal with the consequences later. And Keith, obviously, you've just given a talk about pensions and how to destroy a pension in 22 easy steps. And I like this idea, spend now and we'll deal with those consequences later. And if that's not, the slogan of MMT, I really don't know what is.
It's Keynes too. Keynes said, somebody said, but what did I say? Your policies, we're all going to be dead, and then he said in the long run, we're all dead anyway. It's very cynical. Anyway, we're now later. Okay, we spent and deal with the consequences later. Later means now. Now we're dealing with them.
That is exactly it. The problem with spend now and deal with the consequences later is that it gives the impression to the non-discerning public that deal with the consequences later is simply, well, nothing is going to happen, and everything is happening. And the easy thing, obviously, as we're seeing all over the world, is you blame it on the budget of one prime minister, you blame it on the Ukraine war, you blame it on anything. As the best scapegoat that exists out there is the external enemy. But it's interesting in that in the Eurozone, we've had the same collapse in bond yields, the same collapse in bonds and the same rise in bond yields that we have seen in the United Kingdom, for example. Yet everybody says that all of the problem is Brexit. No, and so it's always anyone to blame except monetary policy. It's never to blame. So the fact that UK pension funds entered into 1.8 trillion pounds of derivatives to cover for the alleged risk of interest rates and inflation, with very little collateral, and that a 20% decrease in the price of those bonds has triggered massive margin calls, is going to be blamed on Brexit. And meanwhile, this morning, Thursday in Japan, the yen is at 32-year lows after the Bank of Japan has been intervening for 2 weeks without stop. At least the abrupt effect of monetary laughing gas coming to an end.
I don't know how it is in the UK. In the US, my understanding of pension funds is that they must continue to pay out at the full rate, essentially until they fall off a cliff. So they pay and they pay and they pay when they run out of money. It's like that. And so decades of falling interest rates have forced them to move out on the risk curve, move out on the yield curve in terms of seeking more duration, move out into assets they should never be owning in a pension in the first place, in my opinion, such as equities. And then finally, leverage via all kinds of mechanisms, including swaps, just to try to make their nut, which is 7 or 8%. You can't go back to the tax-paying public and say the interest rate fell, now we have to get another £1 billion injected of capital. That's not politically feasible, so you just seek more and more leverage. And finally, the favorite trick of borrowing short to buy long assets. And then, you get an uptick in interest rates, and boom, the whole thing collapses like the house of cards that it was for decades, but now finally revealed to be. And and it's Liz Truss's fault.
Exactly.
And how do you explain the rise in yields in the United States? Because it isn't Brexit and it isn't Liz Truss.
No, but it doesn't matter, Keith. The rhetoric is that if something happens in the United States, it will be to blame because of the uncertainty about Trump winning, possibly winning the election someday. They will create a narrative. The narrative that is we have every day on the media in the UK and everywhere else is that anything is to blame except the monster liquidity injection and government spending of 2020, 2021. Everything, and except that.
That's the elephant in the room, so we're not supposed to look at it.
Exactly. So it's like you have this massive elephant in the room. The room is being wrecked, and you blame it on the kids, you blame it on the housewives, you blame it on the husband, you blame it on on the weather, but it's instead of the elephant, and the elephant is there destroying the furniture, and that is what's going on. And obviously now they're blaming on Liz Truss. In the next, everyone that's watching us and listening to us right now, pay attention to this. The next one, the one to blame, will be the Italian government. Will be the Italian government. The next one, the one to blame, will be the alleged rise of the extreme right in Sweden. It's never going to be the ECB or the Bank of England.
Right, and Daniel, I like you posted this. You posted, hey, there's breaking news that the Japanese yen is falling to 149.9 per US dollar, which is a new 32-year low. And you commented that evil Liz Truss. Trying to point out this this joke, which is that why is it that in all these other countries they're having these other structural issues, right? This isn't just something that happened one day out of the blue. These are structural, decades in the making long issues. Obviously, the interest rate being a huge part of that, and because one politician had a plan that some people didn't enjoy, everything now is to be blamed on Liz Truss. When I show up late on my date, it was Liz Truss's fault.
Yeah.
Obviously, if there's bad connection, Liz Truss is messing with the Wi-Fi. And Keith, now I want to go to this point for a second. These are decades in the making long issues, right? The interest rate obviously falling pretty steadily for decades now. How is it possible that printing money, borrowing money, however we want to call it, is that really the panacea that the central banks think it is? Hey, listen, there's a big structural problem. I know what we're going to do. We're just going to print our way out of it. We're going to borrow our way out of it. Maybe I'm not an economist and I just never understand how these ideas work, but maybe you can explain them to me, Keith.
So there's this rusty can on the side of the road, and you go up to it and you give it a kick. And then, hey, that worked. Let's kick it again. And you keep kicking it, but each time it gets a little more dented. There's little tears in the aluminum, and can you keep kicking it forever? So that's the that should be obvious. I guess it isn't. In tension with Adam Smith, who said there's a great deal of ruin in a nation. That these seemingly horribly destructive these horribly destructive policies, and it doesn't blow up right away. Because what they're doing is they're causing the nation to consume its capital. Well, there's a lot of capital in Europe, and there's a lot of capital in America. And, look at Venezuela. They implemented Chavismo, is that what they called it? When Hugo Chavez was elected. And, you get away with it for a while. And Venezuela had far less capital to consume than Europe or America. And they got away with it for, a decade or two. Before things got decidedly nastier around the time that Chavez died, and this guy Nicolas Maduro took over, and then things are worse. And they're like, why can't you bring back the Chavez miracle, as they regard it? Well, Chavez's miracle was consuming capital, and then when it runs out, then the miracle is not repeatable anymore. And so now, now here we are.
I was mentioning this morning to my pupils at the business school where I teach, that in the French Revolution, when they created the assignats, which was a completely fake currency that they created, when hyperinflation came to full front, what the French Revolution did was to try to elect a new Minister of Finance. No? So they looked at three people with different policies. One of them said that they had to stop printing currency. No? The other said that they had to continue printing currency, but they had to slow the pace. Okay. The third one said that what they had to do was to print even more, because the problem was lack of available currency in the system to stimulate the economy. Guess who elected? Who they
I was
elected?
gonna say, let me guess. The first guy went to the guillotine. The second guy went to the Bastille, and the third guy was elected. Let me just guess.
Exactly. The third guy was elected, and this is the reason why, Ben, Keith, the reason why we get so angry and at the same time so surprised that the public, the media, analysts, etc., don't see what is clearly evident, is because there are so many perverse incentives to continue with the aggressive monetary policy that no one wants the lights to come down and the music to stop in the party. The problem is that there's a point, as Keith was mentioning, in which the party is over because you've consumed all the capital in an economy. And obviously, we're far from having consumed all the capital in the economy. That's why things as stupid as what we have seen these past weeks, in which you hear that markets have been calmed by the intervention of the central bank destroying the currency even more. No? So, but ultimately, the problem here is the following: is the law of diminishing returns. Because for a while, the monetary factors do create a sense of acceptability. But it only took a recovery in inflation and inflationary pressures, and people, the average citizens, doesn't believe anymore the narrative. No, first they said it was base effect, second it was temporary, then it was temporary but persistent, then it was temporary but persistent but with long-term side effects. There's lots of adjectives that have been added to the narrative, but
temporary but persistent.
I love that. I love that. That was one of my favorites. Temporary but persistent. No? And the problem is that you basically, the narrative is based on the following: that the central bank that has a perverse incentive in continuing with this policy, and governments that have an even more perverse incentive because they benefit. Money creation is never neutral. They benefit first. Obviously, they pass the problem to the rest. Is that those two agents are going to be the ones that safeguard the reserve of value and the purchasing power of the currency. And it's obviously ridiculous. It's like saying that the guy that's stealing the food in the supermarket is the one that's going to make it viable. No,
the fox guarding the hen house.
You bet.
The problem runs very deep. I've had a number of ongoing arguments, particularly with George Selgin, about this idea that you can have a so-called sound money that's irredeemable currency managed by a central planner, a central bank. If only you do central planning right, and which is just nonsense. And so even I call them the otherwise free marketers. They could tell you what's wrong with the minimum wage. They can say why rent control is going to be harmful. They can explain the problems of tariffs and banking regulation and how it makes it harder to raise capital. They can talk about all these things and explain why a free market is better. But when it comes to money, suddenly it's, well, we need a central bank and we need a fiat currency, and here's the magic formula by which you manage it. No. Don't manage it by inflation and unemployment, as the U.S. does it. Don't manage it by inflation as the way Germany and I think Europe is one mandate, not two mandates. Manage it instead by GDP targeting, nominal GDP, and it's all the same thing. It's the counterfeiting of credit which is they only have one button on their so-called sophisticated dashboard. There's only one knob, which is issue more. The U.S. government or the U.S. Fed right now is trying to unissue currency, and you can see, the enormous problem. So basically, it only goes in one direction, and it's basically a knob that controls the rate at which they're issuing more. The whole thing doesn't work. It's just a process of playing out, feeding out the seed corn. How fast you have the hopper dumping it onto the conveyor belt to feed the people the seed corn, and doesn't really matter which methodology you use. The point is, it's the seed corn going out, and next year we're not going to have a planting, and therefore the following winter we don't have a harvest.
Yeah.
And so, anyways, if even the otherwise free marketers want it, and of course all the monetarists, the Chicago School, all the Keynesians, all the new Keynesians, all the modern monetary theorists, all the so-called neoclassicals, everybody in the economics profession, from left to right to center and everywhere in between, supports this. And every special interest group, Wall Street, of course, loves it. Everybody who owns real estate demands it, et cetera, et cetera. And who is the constituency exactly who stands for sound money?
Yeah.
I mean, it feels like we're a ragtag little bunch, maybe really vocal, maybe a tireless, irate minority, but we're a tiny little group that get, very little mainstream play. The rest of the world just loves this gravy train as they perceive it.
Yeah, but until it stops.
Then everybody will be angry at Bush.
Yeah, exactly. The problem is how this transfers from financial and monetary narrative to a political narrative. No? So now we have learned, this is what we have learned these days, is that if you increase spending and cut taxes and bloat the deficit, it's really, really bad. But if you increase spending and bloat the deficit equally, it's really, really good. This is what we have been told over and over and over again. And it comes from a very simple, at the end of the day, a problem, which is that as the size of government becomes larger and larger in the economy, there are more and more agents that are incentivized to keep increasing the size of government. And it's both on the side of people that receive some subsidies in the form of a currency that is constantly depreciated. They don't understand why those subsidies don't work, or the people that actually benefit because their job is to spend all day saying that the elephant in the room doesn't matter. And look at the narrative of these days. The Bank of Japan intervention doesn't work. What does the IMF immediately come out and say? First, that the Bank of Japan intervention is not enough. Second, that it's targeted and that it's limited. What? What do you mean targeted and limited? The last time I heard Mr. Kuroda talk, he used the word unlimited twice. So this is, for example, what we hear all the time. This morning on TV, somebody said to me, the problem is that central banks are reacting too aggressively and too quickly. And I said, really? That is a problem? Incredible.
I was going to say, that seems to be like that's finance minister candidate number 2 in revolutionary France. We have to print more, but at a slightly slower rate. So central banks should react aggressively, but slightly less aggressively than they're doing now. And I have the magic formula that says 42. 42 is the right number. I'm sorry, that's a reference to Douglas Adams and Hitchhiker's Guide to the Galaxy. If you haven't, for those who are watching this, if you haven't read it, it makes an entertaining read. But it's just a magic number. I mean, who's to say what the right amount is? How targeted and how limited should it be versus what, spray it everywhere?
Yeah.
I mean,
Also,
they live in an unreality, and people support it because they think they're benefiting from it ultimately.
Because this comes exactly. It comes to the point of what Krugman mentioned was the social value of money, which you say, oh, sounds very nice, the social value of money. What does it entail? It means that one economic agent, the government, decides what the value of money has to be in order to disguise its own imbalances. No? And the problem that I see in any case is something that we have been discussing for a while, which is everybody now believes that the entire solution is for central banks to pivot and to continue with this, with a much looser monetary policy. What very few people seem to realize or to say is that in order to continue to support the numerous number of bubbles that have been created in the past years of the so-called bubble of everything, is that pivoting is not enough. Is that it's not just reducing the pace of rate hikes or stopping the rate hikes. It's not just not reducing the balance sheet. Is that what happened between 2020 and 2021 is that the entire market got used to an expanding money supply growth that required more expanding money supply growth because of all the things that you mentioned before, the collaterals and the amount of leverage involved in derivatives.
I was going to say not only expanding, but expanding exponentially while the interest rate continues to fall.
Yeah,
that is what the entire present system depends upon. And if they pause in that, let alone attempt to tighten, they'll destroy, or I shouldn't say destroy. The destruction is already there. I think the Austrian school makes a point that is probably not emphasized enough, even amongst Austrians, and totally unheard outside of Austrian circles. The destruction occurs during the boom.
Yeah.
The bust is simply the accounting, the realization catching up to the reality of what's already occurred. I think that's so they're not causing a destruction. The destruction already happened. They're just causing it to be revealed. When the tide pulls out, you see who's swimming naked. But with this little that they've done, and so I have to give a nod. October is Zombie Month here at the Gold Exchange podcast, and we have several episodes talking about the so-called zombie corporations and zombie debt, which the Bank for International Settlements defines basically as profits less than interest expense, with a few extra stipulations tacked on the end of that. And a zombie only exists, it should be obvious, only exists by grace of two things. One, suppressed interest rates or financial repression.
Yeah.
And two, markets that are so flooded with liquidity that in the desperate reach for yield that, for instance, the pension funds have been undergoing, but everyone else who has a nut to crack, you can't get that without huge leverage, and even leverage isn't enough. You have to reach for the extreme risks. That's why the credit markets are so forgiving, that a company that is unable to pay its interest expense, and part of the definition of zombie is basically unlikely. They're not open-ended, high-tech, high-growth companies. They're unlikely to ever sort of emerge from it. Why is anybody lending them any money?
Yeah.
And the answer is the lenders are more desperate than the borrowers. And that creating that excess of desperation amongst the lender side versus the borrower side is the central banks flooding the economies with, pumping out, I call it credit effluent. It's kind of nasty, it's kind of smelly, it's full of bacteria and icky brown stuff, particles floating around in it. And they pump it out at very high pressure, is what central bank stimulus really is. And then the recipients of that are desperate to unload it into anything that promises a yield, 1 basis point above their own cost of borrow. And thus the zombies get funded.
Yeah.
Now, the problem is those zombies are producing consumer goods and producer goods that enable the producers of consumer goods to produce what they produce. If you destroy all the zombies, first of all, there's going to be a huge unemployment problem. But then secondly, supply of everything is going to go way down because zombies are producing everything. They're a huge proportion of the economy. So do you destroy the zombies and take the blame for most, the average layperson will think that is the central bank caused the Depression, and not merely precipitated it or allowed it to be recognized, or do you just turn up the pumps to warp factor 11, Mr. Sulu, and to mix my metaphors and go to Star Trek there, and of course they're going to turn it to 11. So my prediction is the central banks will not only pivot, but as you said, they will continue to push interest rates down even more and more aggressively pump out credit than ever before. Not because I think that's the right thing to do. There is no, I mean, when you say what's the right thing for a central bank to do, there is no right thing. It's
Yeah.
destruction or distraction. But my prediction is based on politically, there's no way that anybody is going to want to take the pain that recognizing the mess is going to entail. They're going to continue to kick that can down the road until the last shred of aluminum tears off of it and is lost into the weeds. And the only question is when. And my suspicion is it's coming soon. I think there's a lot of wreckage, and the U.S. pension system is probably slightly less badly off than the British pension system, and probably smaller as well. I think a smaller percentage of American workers have a defined benefit pension plan at this point. But my guess is it's coming relatively soon. We'll see.
I would agree with that. I think that the problem for many market participants that are continuing to bet on the Federal Reserve and central bank pivot is that for what it is relatively soon, occur completely, might be very long time for them. Because
long enough for them to go insolvent anyway.
That is exactly the problem. That, by the way, that is exactly the problem of the UK pension funds, because it's not like the UK pension funds, for example, found themselves surprised. The UK has had higher inflation than the average of their comparable economies for a while. The UK's gilt market was completely absorbed by the UK central bank, by the Bank of England, and the Bank of England announced numerous times that they were going to reduce those purchases. Furthermore, the economy was not in the shape of the United States. The United States may have significant challenges as an economy, and we discuss about them, but the UK was certainly quite weaker. So the UK pension funds that multiplied by 3 their exposure to leveraged derivatives were aware of the situation and increased it. So the last batch of margin calls came from a process of trying to capture a little bit more yield out of a portfolio that was in deep negative territory, not in 2022, but in 2021 and 2020.
Double down.
Exactly. That is exactly what is going on, and this is the same thing. I just read, and coming back to the zombie companies, that in Germany, this is not new. Okay, this is not. This doesn't create turmoil in the market. In Germany, Uniper, which was recently bailed out by the German government, may require, as you do, another 40 billion euro of a bailout package. Think about that. It's absolutely
I require a 40 billion euro package. Where's mine?
Exactly. But I come back to the point that you mentioned, is that the narrative is not, what are we doing by bailing out these massive zombie companies? The narrative is not that. The narrative is, where is my zombification? I want my zombification. No? It's like that character in the Matrix that said, I want to be in the Matrix. Please bring me back to the Matrix. I know that this steak is unreal, but I want to come back and taste it.
Yeah, one of the perversities of the welfare system is everybody wants to claim victim status. Because to be a victim is to be entitled to special treatment and subsidies and all kinds of things, and it reverses the normal mechanism of pride and turns it into this abasement. No, I'm hurting even more than you. I'm an even bigger loser than you. No, I'm a bigger loser, and that's the competition. I'm a zombie. I desperately need that money because, of course, it's coming from the non-zombies.
Of
That's the
course.
thing that nobody talks about, and dragging them down into zombiehood themselves.
Mm. But it's
Um,
interesting because I had a meeting with a group of economic leaders on Monday, and one of them said, "What we don't understand is that the environment is completely different from previous crises, because right now, companies that don't make money don't have the need to shut down." But he said that from a positive perspective instead of a negative perspective, and and uh, and there is and one of the reasons why central banks will pivot earlier and probably more aggressively, as you mentioned, is because there is no single government in any developed nation that has even mildly changed its stance on deficit spending and government spending.
to go back to your point about, he said it approvingly that companies that are losing money don't have to close down. We've reached such a level of unreality that people can't tell the difference between a feature and a bug. It's like saying that Windows crashed approvingly. That was
Yeah,
good
yeah,
because I didn't have to do as much work today. That happened at 4:52 p.m. and I figured it would be more than 8 minutes to reboot, so I just shut down for the day and saved 8 minutes. Good thing Windows crashed.
you bet.
How we've gotten to that point is a problem probably centuries in the making philosophically, how things have degraded to the point where, because the people who say this stuff, they know it at some level inside. They know that a wealth destroying enterprise is not a good thing. And what they've done is they've substituted get away with it for good, because getting away with it is the only standard.
Yeah,
And of course, the government has the resources to allow infinite getting away with it, or so they think.
yeah.
And Venezuela could never happen here. And that's the sort of a deeply held faith, I guess.
No, so I think that when we look at the next till the end of the year, mostly the biggest challenge for both businesses and market participants will come from the massive problem of crowding out, because governments bond yields might go up, but governments are not going to find themselves in any real, the UK didn't certainly, a problem to finance themselves. However, that is not the case of the other participants in the economy. So the crowding out effect added to the shrinking of liquidity, even for a short period of time, generates that problem.
I was going to say they use the term austerity, which is roughly, as I can tell, means French candidate for finance minister #2,
Yeah,
which is the growth of the welfare state is slower than we would like. That's austerity. And
exactly.
I don't think politically any major developed economy is willing to even try so-called austerity, let
Yeah,
alone to actually shrink the budget and spend less. There's nobody.
yeah.
So the world just continues to go on. So we were just at the New Orleans Investment Conference, and we had a video set up, and we interviewed a number of the speakers. The general consensus amongst the folks that we interviewed, at least, was that the Fed will continue with the rate hikes that it's announced through the end of the year. After that, I'm not sure there's as much agreement as to what the Fed is going to do next. My personal belief is that, of course, damage and pain is going on with every, at 1 basis point hike is causing somebody at the margin to fail. That's the
Yeah,
definition of the margin, right? Is
yeah,
somebody at the margin is on fire. And but the Fed, I picture them as in this ivory tower that's like 100 stories tall. So from their window, the people are the size of ants and they're running around, and some of them are on fire and they're screaming and whatever, but on the 100th story, you can barely see it, you can't hear it. And they say, oh, well, there's no problem. There's no problem. So the economy is fine, it's holding up well, subprime is contained, whatever they say. So something has to happen to trigger a crisis where the flames are big enough that they rise to the 100th-story window. So now instead of having to look down at the little ants below, they see right out the window the flames are licking at the window, and then they say, well, we have to pivot now. We have to be responsive to the new economic, and of course it isn't new anything, right? It's quite predictable. The unintended consequences are quite predictable. And now we're going to have to respond to that, and that's going to be a pivot, and we're no longer concerned about inflation because demand destruction or whatever it is they're going to say. And the question is, when will there be an event for insolvencies big enough that the flames are reaching the Fed's window on the 100th story of the Ivory Tower?
Yeah.
What will that be? I don't know. When will that be? My guess is fairly soon. But there's a lot of lag in the economy when homeowners feel that they're underwater, and to the extent that they have variable rate mortgages, and of course it accelerates it. Then they stop making their payments, they wait for the bank to begin foreclosure proceedings. Eventually they give the bank the keys and walk away. But the bank is going to go 30, 60, 90, 120. It's like things don't happen immediately. And then the first wave, they began evictions, but they still have reasonable comps, so that they're not writing down the portfolio just yet. The next wave is bigger, and then the comps are starting to be under pressure, so the bank has to start writing down. Although I guess they changed the accounting rules, so maybe the bank doesn't have to mark anything to market anymore. So all these things just delay the onset of recognition, the moment of admitting the damage has occurred. And that moment could be, as you say, quite a long time. I mean, I don't think it's years, but could be. I mean, it could be. It wouldn't surprise me if it was tomorrow. It wouldn't surprise me if it was a year from now. Wouldn't surprise me if it was in 2024. I kind of expect it'll be 2023, first half, because I think there's a lot of things brewing, and it could be any one of them. But it's, that's certainly not investment advice to go out and short the S&P or anything like that.
No, absolutely.
Well, I wanna jump in here for a sec, as long as Liz Truss keeps my internet strong and my connection sound. I really like that we had this moment of getting away with it doesn't mean that it's good. And I kind of want to stop there for a second. I remember Bernie Sanders, he was giving a talk and he was saying, listen, these big corporations, they're getting tax breaks, and they're getting all this money and all these great goodies, free goodies from the government. But his next sentence was the important one. The people should also get those goodies.
Yeah.
Not that the goodies were wrong. Not that these, free money and all these kind of, wink and nudge from the government to say, hey, don't worry about what you're doing. Not that actual action itself was wrong. It's that the people weren't also receiving it. And I think there's a big disconnect here. Economic laws really do apply in some sense. I know, Daniel, you said, someone said, wow, it's incredible. This company is not profitable, and yet it still exists, as if that were a good thing. I remember, I had some friends who would say, oh, this isn't socialism. This is democratic socialism, as if the democratic part is the important part of. No. The socialism part is the important. It's, central banks. I want to go here now. Central banks, the important word is banks, not central. Economic laws still do apply. And it seems like, maybe there's a political privilege to not face reality, but reality still exists. And it looks like in 2023, we're going to start hitting that reality.
I mentioned this recently at a conference. The entire fabric of the system is pushing you to believe that 2 + 2 = 22, but it doesn't. And there's a point in which, and it falls abruptly. This is what we always say, and people rarely understand, is that, but obviously it's like filling up a bath of water and blaming it on the last drop. No, the problem was the last drop. No, the problem is the policy. The problem is the policy. The problem here is that perverse incentive that you just mentioned. Is that what the narrative will tell us, that the decision to target it on a very misguided budget of the UK is very clear on that, is that as long as you are entering into massive deficits to pay for entitlements, that's not a bad thing. But if you dare to reduce taxes and enter into the same deficits, then it's really bad. And it comes back to that incentive, is that why don't people get their bailout? No? In fact, when Jeremy Corbyn, now forgotten in UK, but not his policies, mentioned the concept of quantitative easing for the people, that was exactly it. It was the zombification of families and of small businesses. He wanted the same type of exposure and the same type of problems, not to reduce. No? So that is where central banks will pivot. Right now, it is a problem of markets. Now it's a problem of equity, evil equity holders. Now it's a problem of bond holders. Now it's a problem of private equity, aggressive investors. Okay, that's fine from the central bank perspective. Wait till it becomes a problem of the trillion deficit spending of the Biden presidency, or the trillion deficits, or the tens of billions of deficit spending of the French or German prime ministers.
Yeah, Daniel, there's one of Keith's favorite economists, Francis Coppola, wrote a book called The Case for People's Quantitative Easing. Not that there's an issue with quantitative easing, it's just who is receiving it, Daniel. The money printing, the borrowing, this kind of kicking the can down the road, that's not the problem. It's who gets the benefits of those can kicks. And I think the issue now that we're seeing, of course, is the revealing of this moral hazard. I know risk reward spectrums are, maybe an elephant in the room that we're not allowed to talk about, but there's now an incentive to run on these kind of risk curves to try to get just that little bit of reward. And I know we talked about this idea of there's no right way to do central banking, and this is one of those perverse incentives. When there is no yield, when there's no honest way to make money, people will become riskier, and they will become riskier knowing that, hey, listen, if the pension fund starts to burst, well, we just know that the central bank is going to be there and they're going to make everything okay.
It's not just that you're telling people that money is free, is that you're telling people that money is worthless. Therefore, taking more risk does not have the type of consequences that one would expect. And when those consequences happen, you blame it on the central bank. No, but it comes back to the point of what you said. It's not a problem of central planning. It's a problem of doing central planning right. But that's an oxymoron. You cannot do central planning right. There's no such thing as right central planning, for the very same reason why there's no way in which or if I was in power, I'm going to know exactly what the economy demands at one certain point. I'm always going to run significant perverse incentives. So my concern is that instead of learning from what has happened, what we are doing is creating a new narrative that makes us unlearn from the bond route and the equity valuation collapse. And you have people out there that had huge exposure, for example, to no earnings technology stocks, that have not been blamed at all for buying things that were extremely expensive and extremely risky, but that are blaming central banks on not continuing to pump up the valuation of those stocks.
That's right. The fault is for not doing enough.
Exactly.
To your point about unlearning, I think when it comes to monetary economics, there's been at least a century of unlearning.
Yeah.
Things that used to be grasped pretty clearly are now ancient and forgotten lore. or outright in denial, in the present day. And even the idea of perverse incentive seems hardly to be grasped. People sort of know what you mean by it, but they just want to gloss over it and get back to the fun stuff.
Well, what I found interesting, I was not trained as an economist. I didn't go to school or study economics in school, but I do have something called a brain, and something about things that are illogical or don't make sense, it hurts my brain. And so when I heard about something called a yield curve inversion, my brain hurt a little bit. I had to look into that. What does it mean that the riskier type of yields that I'm trying to acquire actually doesn't give me a higher yield? That confused me. So at Monetary Metals, obviously, we offer a yield on gold paid in gold. And the riskier that either a lease or a bond is, we have to pay you with higher interest rate. There is a risk and a reward spectrum. And that is just true. It's not true if you don't want it to be true, or I'd rather not talk about it being true. It just has to be true that the riskier something is, you should be rewarded with a higher return. And yet we see a yield curve inversion. Keith, I really want to hear what you think about this. Am I just wrong that yield curves, they should kind of look like this weird little monster?
Somebody drew a picture of Jay Powell's face and then rotated it sideways, so like the hump at 20 years was kind of the nose. I thought that was amusing. But obviously, what happens when the yield curve inverts is that there are huge forces of involuntary actions that temporarily take over. And, the Fed is aggressively pushing up essentially the overnight rate, but they have much more limited ability to push up the long bonds. And so you get this inversion. That's not a signal by investors. They think that lending for 30 years is less risky than lending for 1 year. It's that the savers are disenfranchised anyway. It's an irredeemable currency system, and the market has a structure which is perverse. And when you have all these forced involuntary actions, desperately rolling over short-term liabilities and that sort of thing, you get inverted yield curves. And it's one sign that the Fed is not going to be able to persist in hiking rates. I mean, right now, the last inversion is the 3 months to 10 year. What happens when that inverts? And that's only a few basis points away at the moment. What happens when that inverts? To paraphrase Lord of the Rings, where then will you go, Gandalf? Will you enter the mines of Moria? I don't know what they're going to do, but.
Well, Daniel, I wanna get one last question in here before we start finishing up. Zombie firms, obviously it's Zombie Month on the podcast, and we talked a lot about this kind of idea of zombification and maybe the people's zombification. That's really what we need. Maybe that'll be the title of the episode. The people's zombification. But I want to get to a final question here, and obviously predictions are hard because they're about the future, I think is the saying. But do you see this rising rate environment, which is slaying a lot of these zombie companies and putting other companies into zombie status? Do you think that in the next, let's say, 5 years, we're going to see more zombies, that there's just going to have to be a turnaround and an increase in zombie firms? Or do you think that they're really they're going to do it this time? They're going to raise rates and they're going to slay that zombie horde. What do you think?
They're going to raise rates, but they're not going to slay that zombie landscape, because the big problem is the constitution of who are those zombie firms. And the majority of the zombie firms are concentrated on that beautiful spectrum that governments tend to call strategic companies, airlines, automotive companies, big industries. They're not an idiot with a shop that has borrowed too much. They are newspapers, they're media companies, they're telecom companies that are considered that used to be public a few years ago. So, interestingly enough, to your question, is that both things are going to happen. And what that creates is that the entire negative impact of normalization of policy, if we can call it normalization, the entire impact of the rate hikes is going to be absorbed by those businesses and those families that have done the right thing, not by the governments and the zombie companies that have done the wrong thing.
Which is obviously a horrible point, and I don't want to end on a low note. So instead, I'm going to ask you, Daniel, where can we find all your work? Obviously, we love reading you on Twitter. We'll link to your Twitter there. But where else can we find your work? Obviously, your books are all great. Tell us where we can find more Daniel.
Thank you so much. The best way to find me is my blog. It's dlacalle.com. You have it in English and in Spanish. You have also my YouTube channels too, one in Spanish, one in English, and my Twitter, Instagram, Facebook, LinkedIn, TikTok accounts. Unfortunately, it's easier to find me than to avoid me. So Daniel Lacalle is not difficult to find. You just key it in. Just make sure, the only thing I would say to our English-speaking friends is just make sure that you go to the Twitter account that's in English, the website in English, the YouTube channel in English, because we get from time to time comments saying, "Oh, we'd love to have you commenting in English." Well, there is an account in English.
Well, Daniel, I'm going to say, sorry for my bad Spanish, adios from the Gold Exchange podcast, and thanks again for coming on.
Thank you very much, and it's much better to say hasta luego, which means see you later. Adios is very definitive, and I'm hoping that we will continue our dialogue in the future. Thank you so much.
Absolutely.
The way the central banks are working and the markets are looking, it's going to be hasta luego. So hasta luego from the Gold Exchange podcast.
Have a great day.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.